Up to this point, we've been talking about companies that provide services to customers as their source of revenue. There are other types of companies that also generate revenue by providing goods and services to their customers. We call these types of companies merchandise companies because of their sale of products. Now, a merchandise company can be a wholesaler or a retailer, but ultimately they sell a product. They can also provide services to customers to provide revenues, but the key difference here is that they provide a product as a part of their revenue source. So in the past, when we've been looking at an income statement, we were looking at revenues minus expenses. In a merchandise company, we want to expand that revenue minus expense equation to take a look at how much profit we make when we sell the product. So instead of saying revenues minus expenses to get net income, now we take the sales revenue and subtract out cost of goods sold to get gross profit. Then we can subtract out the operating expenses of the company to get net income. Ultimately, we get to the same place of net income, but we add the additional step of determining what the cost of the inventory was in order to generate the sale. So cost of goods sold is the cost of the merchandise that was sold during the period. The difference between the sales revenue and the cost of goods sold is called gross profit. Now, gross profit is very important because in many cases, companies compensate their salespeople based upon gross profit rather than the sales revenue. Gross profit is a far better incentive for a salesperson than sales revenue in the perspective of the company because we want the salesperson to maximize the profit on the sale. So in a service company, we would talk of an operating cycle where we take our cash, perform the services for our customers, we bill our customers in the form of accounts receivable, and then we receive the cash from the customer. In a merchandise company, we have several new steps in that we start with cash to buy inventory. We take the inventory and then we sell it to our customers, and then we bill the customer to receive cash. Typically, a merchandise company takes longer from the point of using their cash to getting the cash from the customer. Here is a graphic to illustrate the flow of costs in merchandise inventory. You take the beginning inventory and the cost of the new inventory that you've just purchased to receive what we call cost of goods available for sale. The cost of goods available for sale can either be sold as cost of goods sold in the current period, or it'll remain in inventory for next period. Next period, the ending inventory in this period will become the beginning inventory in the next period. So in other words, we could create an equation of beginning inventory plus the cost of goods purchased equals the goods available for sale. Then we can subtract out the ending inventory to get the cost of goods sold. Now, companies will take this equation and they will look at their inventory and keep track of their inventory one of two ways, either using the periodic inventory system or the perpetual inventory system. The difference is that the periodic inventory system waits till the end of the month to determine how much is in ending inventory. Typically, companies that use the periodic inventory system will need to make a physical inventory count of all their inventory at the end of the period in order to determine how much is in ending inventory. By calculating the cost of goods available for sale and subtracting out how much is in ending inventory at the end of the period, we can calculate how much the cost of goods sold is. Most companies today use the perpetual inventory system because of the age of technology. In the perpetual inventory system, companies maintain detailed records of each of their inventory transactions of purchases as well as sales. Immediately at the time of the sale, the inventory is decreased out of the accounting system so that the company knows exactly how much inventory they have in place at any given time. Also, they can compute the cost of goods sold for the transaction at the time of sale. The periodic inventory system is still used by many companies just because of its simplicity. We can calculate the cost of goods sold by taking the beginning inventory and adding the purchases to give us the goods available for sale. We subtract out the ending inventory to get the value for cost of goods sold. The primary reason that companies use the periodic inventory system is that then they don't have to treat the sales transaction for cost of goods sold at the time of the sale. However, because we're using the matching principle, we want to make sure that we recognize the cost of goods sold expense in the same period as the revenue. So at the end of the month, we have to count all inventory items to determine what's left over in inventory so that we can calculate the cost of goods sold. The advantages of the perpetual inventory system: we can keep track of a large amount of inventory all at the same time and know exactly the quantities and the cost of the inventory on hand at any given time. By doing so, we can control the inventory, and we also know where all our inventory is at any given time. So what's the importance of keeping track of inventory? Remember the days when you would go to a store and you would ask somebody if certain inventory items were available. In the old days, where companies used the periodic inventory system, they could only tell you what they knew was in inventory at any given time. They would pretty much say, well, let me go check in the warehouse, and they would say, this is what we have. Today, when you go to a retail store and ask for if something is in stock, you can actually ask them, where is it located? So if a particular store does not have inventory, their perpetual inventory system is now linked with all their other stores that they can tell you exactly if a store has inventory at any given time. So the advantage of perpetual inventory is that we have better control of our inventory, and we know where all our costs are associated with those inventory balances.